Hello everyone, this is Mortgage Sensei here, back with a great video. Today what I want to talk about is different ways you can go about lowering your DTI, or aka your debt to income ratio. It's going to be a two-part video. This first part is going to be dealing strictly with how to lower your debts, and then I'll follow up with another video for you tomorrow on how to increase your income, which I think a lot of people are going to love there. So 5 ways to lower your debts when it comes to your debt to income ratio. Number 1, refinance your debts. So basically you want to call up your creditor, whoever it may be, the bank, the lender, whatever case it may be. And ultimately what you're trying to do is get a lower monthly payment. This could be in a form of getting a lower interest rate. It can be in a form of extending your term out in order to lower the payment. Or maybe you've paid your balance down and you want to keep the term about the same, and then you refinance from that aspect. But ultimately, your goal is to try and lower your monthly payment. Number 2, pay off those debts. Now, there's 2 ways you can go about doing this. If you're trying to pay off debts and go through the process, then as a loan originator, we can mark those debts to be paid at closing. So it'll be a part of your total closing costs, or it'll be separate, but it's a part of the closing cost, or the total funds you got to bring to closing. And we'll get a payoff letter, a whole 9 yards, and we'll take care of it for you at closing, and we can lower your debt to income ratio by removing those monthly payments. The second way with that is to do what is called a debt snowball effect. Basically, you're going to ensure you make all of your minimum monthly payments for all of your debts that's being reported to credit, or any requirement through the state, local, federal government, or the case may be. And any and all extra amount of money that you have, you want to apply that to the balance that is the smallest. So whatever debt that has the smallest amount of balance that you have extra money, you can apply it towards the balance to get it paid off. So that is the debt snowball effect. Step number 3, or the third way, is to get to a point where you have less than 10 months of payments on any installment loan. An installment loan is like an auto loan, a personal loan, anything where you're making payments back to, not a lease or anything like that. But once you get less than 10 months payment, we as loan originators, we can exclude that debt from your calculation and help lower your overall debt to income ratio to help you qualify. Number 4, refinance that debt into someone else's name. What you're trying to do is relieve your obligation to make those monthly payments from yourself to someone else. Now, I see this happen with family members or spouses, where, maybe a couple, just a scenario, guys, husband and wife are together looking to buy a house. We may be doing the loan in just the husband name or in just the wife name, or whatever the case may be. Well, they'll go about refinancing the debt, moving it from their name to the other person's name, and do the loan strictly in one of the spouse's name. Now, you do got to be a little bit careful. Make sure you're not doing a government loan in a community property state, but that is a great and easy technique in order to lower your debt to income ratio to help you qualify for a home purchase. And number 5, the 5th way, is to get a lower housing payment. Now, this is for the actual home in which you're looking to purchase, right? This is what we're talking about. So a couple of ways, just an example, get a lower interest rate. That's directly tied to trying to get your credit score as high as you possibly can. That way we can get a lower rate, which leads to a lower payment, which leads to a lower debt to income ratio to help you qualify for the house that you want. You can look into lowering or removing PMI. You can lower your PMI by getting a higher interest rate. You can remove your PMI by putting more money down. Definitely at least 10%, but probably closer to 20% down payment to remove PMI. Unless you're a veteran, there's no PMI with that loan. Or USDA, I'll throw it in there because the PMI is so minimum. It doesn't make a whole hill of beans when it comes to getting a home. Another way is also get a lower loan amount. This could be just, choose less house or lower price house. That's directly tied to the housing payment. You can look at going with the longest possible term that you can. In most cases, we are looking at a 30-year fixed mortgage or something along those lines. You can look at adjustable rate mortgages or buy down type of mortgages. This is an introductory low interest rate that you can get for the first couple or few years in order to have a more manageable payment. And also you can look at getting a lower homeowner's insurance, right? This is a premium that's inclusive with your total monthly payment. So a lower insurance premium means a lower payment, means a lower DTI. This is Nelson Thompson, aka the Mortgage Sensei here, powered by Edge Home Finance, and I'll see you on the other side of mortgage home ownership. And real quick, for all those that's watching this video, please like, follow, subscribe, drop a comment. Let me know what you want to see. Let me know what's on your mind, scenarios you're running into, and I'll see you again soon.